Right, good morning, everyone. We'll get started. We stop here at case studies 5B, communication with clients. Right, those who have come in late, next time, try to be early, please. Try to wait before 11. Those who come in late, please be early next time. Okay. Right, case studies, right? 5B, communication with clients and prospective clients. Right, so this lady, Sarah, right, she's the director of marketing for country technicians. Okay, she's convinced that she has found the perfect formula for increasing country technicians' income and diversifying its product base. Right, Williamson's plan built on country technicians' reputation as a leading money manager by marketing an exclusive and expensive investment advice letter to high net worth individuals. Right, one hitch in the plan is the complexity of country technicians' investment system, a combination of technical trading rules based on historical price and volume fluctuations, and portfolio construction rules designed to minimize risk. To simplify the newsletter, she decides to include only each week's top 5 buy and sell recommendations and leave out details of the valuation models and the portfolio structuring scheme. Right. Wong Kok Chin, next time please come early. Right. So now this is about communications, right? Someone is coming in late. Wong Kok Chin, next time try to be early, please. Right. So now communications, right? This part here, right? Now she's doing it for her own convenience, right? You can say she's doing it for own convenience, right? To simplify the newsletter, right? She decides to include only each week's top 5 and sell recommendations, and she's leaving something out. Okay. Right. So basically, this process of inclusion and exclusion, right? This process of inclusion and exclusion, it wasn't properly communicated to the clients, right? Now, as to the logic here, there seems to be no logic, right? There seems to be no logic as to the inclusion and the exclusion, right? I think the logic is, she's trying to just simplify the newsletter, right? And now the process, right? This is a process, right? The valuation models, right? And the portfolio structuring schemes, right? So this part here will be the investment, is part of the investment process. The line I outline in purple, that is part of the investment process, right? And this is her logic, just to simplify the newsletter. Okay, so so there's no proper communication to the client as to how the securities are selected, right? Okay, and as to the process, now in leaving this out, right? So the client doesn't know how you do it. Okay, so the clients don't really understand your process. Right, so the issue here is sufficient disclosure of your investment system. Right, the investment system here. This is the investment system, the balance sheet models, and the portfolio structuring scheme. So the question here, whether it is sufficient disclosure. Now, has she violated? Yes, right? Right, yeah, you need not be in detail, right? But you must inform the clients, right, of the basic process and logic. So, right, this part here, okay? So without, understanding the basis for recommendation, right, the clients cannot possibly understand its limitations, right, or its inherent risk, okay? So she has left two things out, right? She has left this out, right, because of this reason, okay? Right, Richard Docks, right, is a mining analyst for East Bank Securities. Okay, now he has just finished his report, right, on Boise Bay Minerals. Included in his report is his own assessment of the geological extent of mineral reserves likely to be found on the company's land. Okay, so Docks completed his calculation based on the core samples from the company's latest drilling. So according to his calculation, the company has in excess of 500,000 ounces of gold on the property. Right, so Docks concludes, right, so he made a conclusion, right, according to his calculation, right? So based on the fact, now his calculations are not facts, right? So based on the fact, again, right, based on the fact, right? So this is his statement, right? Now see, quote unquote, right? Quote unquote, this is his statement. Based on the fact that the company has this amount of gold in mind, I recommend a strong buy. Right. So now he has written this report, right? But if he has issued it, right, to the public, then he will violate this standard 5B, right? Because this part here, right, is an opinion, right? Is an opinion. This is his opinion. Okay, so that's why we say, right, opinion must be distinguished from fact, right? So this is just his opinion, his calculation. All right. So basically, he's providing opinion as facts. Okay. So has he violated? Yes. Right. I've already said this, right? Presenting opinion as facts. So opinion must be distinguished from fact, right? In research reports. Right. Olivia, right? She's the analyst at Government Brokers, right? This is a brokerage firm specializing in government bond trading. Has produced a report that describes an investment strategy designed to benefit from an expected decline in interest rates. Okay, the firm's derivative products group has designed a structured product that will allow the firm's clients to benefit from this strategy. Right, Thomas' report describing the strategy indicates that high returns are possible if various scenarios for declining interest rates are assumed. Okay, now, so citing the proprietary nature of the structured product underlying the strategy. All right, the report does not describe, okay, in detail how the firm is able to offer such returns in the scenarios, nor nor does the report address the likely returns of the strategy if, contrary to expectation, interest rate rise. Right, so on both sides, if it goes either way, right? Okay, if the investment goes either way, you must provide the appropriate scenarios, right? So the actual risk here of this investment strategy has not been described to the client. Okay, right? So and then when you talk about this sort of investments, right, probably there's some kind of borrowing leverage. So the amount of leverage also it wasn't being described. Okay, right? So now interest rates can either rise or fall. Okay, interest rate can either rise or fall. Right? So she didn't provide the scenarios for for both scenarios, but when interest rates rise and also fall. All right. So not only that, right? She should also provide a variety of scenarios. Okay. Now she does not do that. Okay. Right. So there are actually other issues, right? Like gearing, liquidity. You know, uh, it's not being considered. All right. Right. So the issue here is about proper description of a security. So this comes under communications to clients, right? So there's no proper description here. Has she violated? Yes. Right. So this is the first part, right? Describe properly the actual implied risk. Okay. And the structure, right? And the leverage, right? These two other points, right? So the risk, the structure, and the leverage. All right. So this is what she should be doing, right? So basically, she should provide a balanced discussion, right? Okay. Rising as well as falling interest rates, right? I mean, preferably, right? So this is even better, right? She should provide a reasonable variety of interest rate and credit spread scenarios. Okay, this is more realistic. Okay, more balanced. What you call a more balanced discussion. All right, and well, liquidity is also important besides like this credit spread, because liquidity, the investor will want to sell too. So liquidity issues are also important. When you talk about valuation, okay, either of the security or or the derivative, right? So liquidity risk should also be addressed, right? In other words, okay. Right, case 6. Any questions so far? You can ask me, interrupt me. RJZ Capital Management is an active value style equity manager that selects stocks by using a combination of 4 multi-factor models. The firm has found favorable results when backtesting the most recent 10 years of available market data in a new dividend discount model designed by the firm. All right. This model is based on projected inflation rates, earnings growth rates, and interest rates. Right? The president of RJZ decides to replace a simple model that uses price to trailing 12 months earnings with the new DDM. Right? So now, this change in the investment process is quite substantial, right? So this change, this replacement, right, must be communicated to the firm's client, right? So now another thing is that right, the old model is based on hard data, right? Now this is hard data using price to trailing 12 months earnings, right? So trailing, right, rolling 12 months data, right? So this new DDM probably use projections, right? Projections. You can use projections, right? You remember those formulas that you use to calculate DDM, right? Growth rate, growth rate in the future, expected rate of return, right? So these these two inputs, right, requires you to be able to forecast these two variables accurately, right? So the key issue here is, right, there's a significant change, right, of the investment process, right? Significant change, because you're using a completely new model. All right, so this has to be communicated to the client, right? So, right, so this represents a material change in the investment process, right? You must communicate this change, and he didn't, right? So another issue here is that you're moving from a model based on hard data, right? Probably this is more reliable. Yeah, even though the past is no guarantee of the future, right? Probably this is a more reliable model. Now you're using a model that depends on forecasting skills, so the new model may not be that reliable, right? But the key issue here, right, under this section, right, it's the significant change of the model, right? It's a significant change, not a mere refinement of the process. It's a completely new model, right? So this change must be communicated to the firm's client. Right, so case 7, AZAC Capital loses the chief architect of its multi-factor valuation system. Right, so this guy has left. All right, so without informing his clients, right, the president of AZAC decides to redirect the firm's talent and resources towards developing a product, right, for passive equity management, a product that will emulate the performance of a major market index. Now, I mean, you see, the valuation system has changed, right? Now, initially, you're using a multi-factor valuation system, okay? Right? So this is very different, right, from following a major market index, right? Now, if you follow a major market index, basically the investment style is quite passive. It's very passive, right? So if you're using a multi-factor valuation system, the investment style is very active, right? So from an active system to a passive system, all right? Uh, so here the key issue here is without informing his clients. He didn't inform his clients, right? They change the value system, right, from an active system to a very passive system, right? It's a major change, right? So failure to disclose this major change means that AZAC has violated 5B, all right? Right, so these are all in your notes, okay? Right, case 8. At Fundamental Asset Management Incorporation, the responsibility for selecting stocks for addition to the firm's approved list has just been shifted from individual security analysts to a committee consisting of the research director and 3 senior portfolio managers, right? Right, so probably, right, see, these individual analysts, probably they are more independent, all right? Now you're shifting to a committee, right, to a research director and 3 senior portfolio managers. Maybe this committee, maybe this guy is quite influential, right? And so probably this committee means that it's not so independent, right, as these individual security analysts. All right. So Eleanor Morales, a portfolio manager with fundamental asset management, thinks this change is not important enough, right? She thinks it's not important enough and fails to notify her clients of the change, right? So now this this is regarding stock selection, okay, right? Stock selection, right? So change in the investment process, but more particularly stock selection, right? Selecting stocks, right? So now this is a major change actually. All right. So now, right. So there's this issue of morale and motivation, right? So this individual security analyst, right? Their morale and motivation, right, may have suffered because of this change. Okay, so this in a way is not good for the firm, right? So now this, I mean, probably the expertise, of this individual security analysts are more reliable. Okay, now the research director and the 3 senior portfolio managers, right? Their expertise might be challenged, right? They may not be that good, right, as this individual security analyst, right? So clients may not be happy, right? And they may want to monitor the situation even more closely, so wasting the time. All right. So they are paid for the services, but then they have to spend more time, you know, to see if this research director and the senior portfolio manager who makes up this committee, right, really has the expertise, to replace these individual security analysts. Okay. Right. Has he violated? Yeah. So you must disclose the change. Right. That's the first part. All right. You must disclose. So, I mean, these are just some of the issues that might be involved, right? I already talked about this. All right. Another issue here, the clients may challenge, right, the stock picking track record of the portfolio managers because it is unproven, right? And they might even want to monitor the situation closely. So this is not good, actually, right? The clients are spending more time. Right. So I've talked about B. Right now, I'll talk about the 5C, right? Record retention. Right. So record retention 5C, right? The gist of this standard is you must develop and maintain, right, appropriate records, right, to support, your investment analysis, recommendations, actions, right, and other investment related communication with clients and prospective clients. That's the first part. All right. So what's the basis for this 5C, right? Records, right, are the property of the firm, period. Okay. And then we talk a bit about local requirements. Right, record retention. Right, so according to 5C, right, you must retain the records that substantiate. So this is the supporting part, right, of your research and the reasons for your actions or conclusion. You must retain that. So your records, right, can be hard copy or electronic, right? And the other point, records are the property of the firm. Now, if you want to take copies away, you must have express consent. Okay. And you must follow the regulatory requirements regarding record retention. Okay, right? And usually the regulation says, right, you must maintain records for at least 7 years. Okay, so this is the main gist of the local regulatory requirements. Right, recommended procedures for compliance. Right, so now this is the firm record, right? The firm needs to keep a record, right? So primary responsibility rests with the firm rather than individuals. Okay, but individuals work for the firm, right? Individuals work for the firm, so the individual should retain the research notes, right, and other documents, right? So all the supporting documents, regarding all these investments, right? You know, uh, to assist the firms in complying with the internal or external record preservation requirements. All right, so individuals should be doing it as well, right? Even though the firm has the primary responsibility. Right, some case studies on 5C, record retention. Right, so one of Nicholas Lindstrom's client is upset by the negative investment returns in his equity portfolio. The investment policy statement for the client requires that the portfolio manager follow a benchmark-oriented approach. All right, so benchmark-oriented approach, right? The benchmark for the client includes a 35% investment allocation in the tech sector. Okay, this is the IPS, right? So the client acknowledges that this allocation was appropriate. But over the past